All right, we have to talk about the jobs opening report that just came out, and it's helping with the markets quite a lot. But afterwards, we also have to cover a little bit about the interest rates in China. That was also quite interesting because that's going to be moving a little bit more, and also something to do with the US banks. Okay, so let's start with the jobs report. The jobs opening actually had a huge decline. We were actually expecting the forecast of a little bit more than 9 million jobs opening. But surprisingly, we actually got down to about 8.83 million jobs opening. So what does that actually entails for the market? The market is liking it. Okay, the market is liking it. But personally, I don't think that's really that big of a deal. Okay, two things that we have to get rid of. Because the first thing is that a lot of people are expecting, okay, to have lesser job openings also equals to more jobs, effectively. Okay, you got less vacancy, hence that means more jobs are being filled. There are more people looking for jobs. So now, if you were to look at it from the other lens, the lens that I adapt to, would most likely be good because, with lesser vacancy, what could actually be the case is that, people are taking up more jobs because maybe prices of things are too expensive. One job is not cutting it. We need two jobs, or some people with 2 jobs needs 3 jobs. People might have their own day job and they might actually be moving on to drive for Uber. They might be doing DoorDash and things like that. And of course, all these different things might play into this, especially for job openings. However, at the same time, what can also be the whole point about vacancy can also be that companies are just not hiring more. What could actually be happening are that companies who are hiring aggressively back in 2021, 2022, maybe in 2023, they're just cutting back. After the huge layoff that we actually seen at the late 2022, early 2023, after we see that huge layoff happening back then, right now a lot of companies are a lot more cautious when they do a lot of hiring. So I'm thinking maybe at this point you might see a little bit lowering of the vacancy as well. But hey, of course, nevertheless, a good number is a good number. You call it what it is, and the markets are absolutely loving it. You can see that the SPY themselves are up about 0.8%. The NASDAQ is up a little bit more than 1%. So effectively, I think that the market is pretty much liking this data so far. Okay, now we have to move on to the next interesting news, which is about Chinese bank. Okay, since we're talking about interest rates for a little bit, let's talk about Chinese interest rate. Chinese interest rate, the China banks are actually cutting rates on all the mortgages, deposits and things like that for all the different rates. So how is this actually possible for them to be the second biggest economy in this current era? All your different other markets out there, your US markets, your European markets, your Asian markets, everyone is actually slowing down their rate hikes, or some of them are even effectively just wanting to go even higher. While China banks, on the other hand, is already cutting rates on mortgages. So what's actually happening? So are they really in the emergency sort of era where they have to actually start cutting rates? And I think this kind of comes without a doubt because it's just, we have seen the Chinese market suffer a little bit, especially after what happened with the whole Evergrande situation. And then afterwards, they had a little bit of a issue with all their different interest rates. Now for the China banks to actually start cutting rates on mortgages and deposits in a stimulus rush, hey man, I think it kind of makes sense. So it's going to be quite interesting for us to really see. Of course, according to Larry Hu, head of China economics at Macquarie Group, apparently he's saying that this is an incremental policy step, not a game changer, because people's confidence is still low. I think we're going to see property easing come through in the coming weeks. I just don't know if it's going to be strong enough. I do think that property easing will definitely be coming, but I do not see it coming in the short term. I see it coming in the next 5 to 10 years because it's not going to be easy for people to suddenly start trusting in all these different property managers again. It's not easy for them to start trusting all these developments because there's so many issues with the property developments down to the material, down to the labor work of all these different real estates that they were actually building. So yeah, I think there's a lot of concern for the properties in China. And let's not forget that because property is also basically branded as one of the most important assets to have, especially if you are in an Asian country, like in Singapore as well. All right, so now finally we have those who talk about how US intends to hit banks with more long-term debt minimums. So I think there's going to be a huge thing for banks, but it's not going to be a huge thing for a long term, because the thing is that we've been hearing about this over and over again for almost every 2 years now. They always talk about how US wants to ensure that banks have a they want to ensure that banks would have the long-term debt minimums and things like that. This is to ensure that people do not commit to basically 30-year mortgages, mortgages, bonds and such, at low percentages and then get destroyed when interest rate increases, such as what happened with Silicon Valley Bank. And I think that these are just basically risk assessment sort of thing for what the US is trying to do, for them to actually work together with the banks, for them to not get screwed over in the long run. So yeah, I think effectively right now in market it's going to be a little bit more busy, because you're going to be hearing a lot of different news about all the different banks. They're starting to find a way to get out of the whole credit crisis that we were actually having back then. Right now, banks are getting downgraded as well, and there's a lot of this kind of thing going on. And let's not forget, politics is going to be playing a huge part of this in the later part of this year, closing to 2024, because the elections are going to be coming up, and there's going to be a lot of political play in the whole entire economy system as well. Most likely going to see rates move a lot, either downwards or upwards. I don't know, because that's going to be a lot of what the Biden administration wants to do to ensure that he get re-elected. There's going to be a lot of punching of holes in the different logic for their bills and such, because the Republicans are most likely going to be going down on the Democrats' throat to ensure that they are actually standing their side of the bargain. I think that's going to be pretty interesting. So yeah, I think election period in general, it has always been quite interesting. So I do think that that's going to be where you really see a lot of juicy information come out, especially when US politics is generally quite entertaining, I'm not gonna lie, especially with Trump, especially going through the whole entire going to Atlanta jail and all this different thing. Of course, we have to also look into all those different things as well. But anyway, I will most likely be talking about, I'm most likely going to be covering whatever Trump is going through in the past month into one video. I'm not sure when that video is going to be dropping. It might be dropping next week or 2 weeks from now, I'm not sure. But yeah, anyway, that's all I have for this video. I'm going to be preparing to go to the gym right now after looking at some more news article and such. But anyway, that's all I have for this video. Thank you so much for watching, and I hope to see you guys in the next one. Thank you. Peace. Bye.